with how trade played out today. We're down 0.6%, so more downward pressure. Yesterday we saw a little bit of an increase for the NSE 20, but unfortunately we're starting to break very key technical levels, and of course this creating concern as to whether we are going to see more upside going forward.
The market today, despite the downward pressure yesterday, we saw a lot of local fund managers come in to take up buy positions, which played a key role in the turnover because it was up to about 288 million from yesterday's low of about 204 million. So I think in the coming weeks we should see improvement in the market, in market activity, as we see fund managers coming in to take up positions in stocks which they feel are well priced. We also saw a lot of foreign presence in Safaricom. There was also a lot of buy pressure, with it had the highest turnover at about 12 million. But we also saw Access, which closed its books yesterday. It also did pretty well, and so did KCB.
Well, turning our attention to the shilling, as I said, there was a poll out today showing that most investors are confident that we'll be seeing strength coming through in the shilling by June 2011, and they're talking about a level of 78.88 to the US dollar. This is because the current account balance looking a lot better, and also a lot of positivity surrounding the referendum. Your view on this? Do you think it's likely that we could see some strength, or do you think that the central bank could perhaps step in and try and keep the currency at around 80 to the dollar purely because of the export scenario?
Okay, what we've seen happening so far in the past few weeks, I'd say, is every time the shilling looked like it was going below the 80 mark, the central bank came in. But I think I do agree with that poll. On the back of improved confidence in the Kenyan political scene. And even today, we've seen the Kenya shilling strengthening on the back of employment data just coming out from the United States. So I actually do agree with that poll. We should see the shilling strengthening in the coming days, because the central bank can only do so much against market pressures. So I do agree with the poll.
Exactly. I mean, how much can the central bank do? Because we know they came in and bought around $8 million not too long ago. So we have been seeing a lot of intervention at this point. Do you think that the central bank prefers to see an 80 to the dollar level, or perhaps 81 to the dollar level?
Pardon?
Do you think that the central bank prefers to see a shilling that is trading at around 80 to the US dollar or 81 to the US dollar? Because we have seen them come in and buy US dollars to try and weaken the currency.
Of course, any central bank would prefer, where, especially in an economy like ours, where we really depend on our exports. But as I said, they can only do so much against market pressures. So as we see economic improvement, and especially with the projections for this, the fiscal year 2010-2011, I think at some point they'll have to sit back and let the market play out.
Well, just looking at the bond market, because we've also seen quite a lot of interest coming through on the fixed income market. Tell us about the yields at this point in time. Do you think that they're still looking attractive for most investors?
What has happened with the yields is that there's been a slight upturn in the yield rates over the past 6 weeks or so. But after this infrastructure bond that was issued about 3 days ago, we've seen activity coming back, because it was issued at a high of about an average of about 7.2. So activity has come back. It's been trading it's fallen by about, let's say, 70 basis points since it was issued on Tuesday. So that's a good sign for the market. And also looking at the government's borrowing budget for this year, they were looking to borrow about 105 billion. And they've done almost 50% of that in the first 3 months of the financial year. So we should see them slowing down in the coming days, which should also lead to quite a bit more activity on the secondary market as fund managers and banks look for a home for their funds.
Just zooming in on the cutoff rate of the 182-day Treasury bill, which rose around 2.2% at the auction today from 2.15% around 2 weeks ago. So basically flat, I would say.
Yes, I do agree with you. The indication we got from yesterday's results of the 182-day Treasury bill is that the upward pressure on rates is actually starting to slow down. But there's also quite a bit of liquidity in the market. The liquidity level has come down to levels, I mean, the interbank rate, which is a good measure of liquidity levels in the market, has come down to about 1.4%. So that also translated to the 182-day having an oversubscription of about 12%, which as compared to the 91-day, which had only an oversubscription of 7% the week before. So I think this is a good indicator that the upward pressure on the rates is actually starting to slow down. There's less pressure, and in the coming weeks we should see a turnaround in the rates as they begin to decline, be it marginally.
So let's zoom into corporate bonds versus government bonds, and in terms of the interest from the investor market out there. And the reason I mention this is many corporates out there have come out and issued bonds to try and raise capital. Do you think that the one is deemed more risky than the other?
Of course, corporate bonds are always deemed more risky. I think the last corporate bond that was issued that had a lot of interest from the market was the Kenyan bond. But you should also take into account that Kenyan is 70% owned by the Kenyan government, so the risk was not that great. But for example, Housing Finance are issuing a bond in the coming month. So the risk on that bond is a bit higher, and that's why we see banks not participating so heavily in corporate bonds. We should see fund managers quite interested, because we're expecting them to issue anywhere between a 5 and a 10-year tenor bond. So that should be about what they'll go about let's say 200 to 300 basis points above market rates to be able to elicit enough interest in the paper.
We spoke to Housing Finance yesterday, and it seems they seem very confident about the uptake of this bond, and obviously it is about propping up the property market as well. How do you see this bond performing going forward? And you're saying that there are slight risks that are going to be involved.
I think the bond will perform pretty well, looking at market indications on the property market. But there have been a few concerns raised on their balance sheets and whether they can be able to handle a 10 billion issue. But I find 10 billion is not a lot, so it should be taken up by most local fund managers.